Hey, welcome back to YT Finance, and today we are talking about if right now is a good time to buy and accrue assets like buying stocks on the stock market while interest rates are very high, inflation is running rampant, and the overall stock market is dropping right now on top of the threats of a recession. And then after we go over whether or not you should be buying stocks right now, I'm going to be going over one of the stocks that I personally am acquiring at a big discount, which is going to be Amazon stock. So for more videos just like this one, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, but now let's jump right into today's stories. So despite the recent sell-off of the overall stock market, which definitely could get worse, smart investors are actually looking at this as a time to buy stocks and companies that are fundamentally undervalued right now. So they're using the stock market pullback to actually invest into their core plays and positions. For instance, the S&P 500, which is a stock market benchmark, has fallen by around 23% since it peaked back in December. Likewise, the Dow Jones Industrial Average is down around 20%, with the Nasdaq Composite dropping lower than both of those indexes. And this is actually exactly why you should be buying stocks right now, because while the stock market is falling, that's when I actually start to buy and accrue my core investments, which would be ETFs like VOO, VTI, QQQ, MTUM, and many others. This is literally the best time to invest and to dollar cost average into very diversified assets or a basket of stocks. Historically, the calendar is actually working in our favor, to where over the short term, the stock market could trend downward for the next few months or even the next few years. However, over the long term, investors that decide to dollar cost average into the market, those are the investors that tend to build wealth over the long term and become much more wealthy than stock traders who are trying to time the market. For instance, we can rely on the advice of Warren Buffett, who is arguably the best investor to ever live, where he says this, and I quote, "Be fearful when others are greedy, and greedy when others are fearful." Basically, what this is telling us to do is to buy companies that are fundamentally solid while the stock market is falling and the stock prices are decreasing. And yes, you are going to lose value on paper, but over the long term, you're actually going to have amazing compounding growth, and that's exactly what the data backs. It backs Warren Buffett's assertion of this, and it's completely true if we look at it over the long run. Some of the data that actually tells us this comes from a mutual fund company named Hartford, because when they started to crunch the numbers and look at all the data, it actually indicates that on average a bear market or a stock market downtrend and or crash from 1929 until the present only lasted on average around 289 days or 9.6 months. And then after that, we see a huge bounce back and recovery and rally from these lows in the S&P 500 and other indices and indexes. However, I am not advocating that we count out 289 days and then that's when the stock market would be recovered or will start to recover. But it is a good average metric that we can use that should invigorate us to stay the course and consistently dollar cost average into a basket of stocks like an ETF or a mutual fund or an index fund over the long term, to consistently buy into that core play, which should probably make up the majority of your portfolio. For me personally, I have ETFs that make up the bulk of my overall holdings, and then I have my single risky growth stocks, which I am just holding right now. I'm not really adding any more to those positions because of the current economy and the overall stock market and what it's doing right now. But if we look at the data over the long term, we can tell that long-term investors that dollar cost average into an index fund, a mutual fund, or an ETF that performs on par with the S&P 500 stock market benchmark builds wealth over the long term. And that's how millionaires actually attain the majority of their wealth, besides building their own business and a couple other ways. I also want to point out that the markets somewhat have a tendency to end bear markets at the end or beginning of October, where September normally is the month that has the worst stock market gains. It actually tends to correct or downtrend in the month of September, but in the month of October, either in the beginning or the end, that's when bull markets tend to actually start. start. Now, I'm not advocating or saying that right now we could anticipate a bull market run from October onwards, but I am going to say that we could see some stock price appreciation in the general stock market depending on the overall economy and how it's looking. But one thing we definitely don't want to miss is a bounce or a stock market recovery. And the way we can ensure that we don't miss this is to continuously dollar cost average into the stock market and not sell any of our core holdings. For instance, if you're dollar cost averaging into ETFs like VOO or VTI, then you would not want to sell these ETFs for literally any reason, even if the stock market crashes, because if you miss the actual opportunity of a stock market bounce back, you're going to lose a lot more money than you wanted to, and I'll get into the numbers here in a minute. But overall, we don't want to miss when the economy or the stock market recovers. And why wouldn't we want to miss a rebound? Well, according to the brokerage firm Edward Jones, they actually say that if you missed out on the 5 most recent transitions, recoveries, and rallies out of a bear market, you would have lost substantial gains, because on average, the S&P 500 rallied by around 25%, and if we multiply that by around 5, we get 125%. So you would literally have less than half of the gains than someone who kept their money in the market and continued to dollar cost average into it despite us entering or being in a bear market. Because whenever it bounces back, and remember, no one really knows when that's going to happen, that's when the real gains are made. So I don't want investors to miss out on that substantial increase of 125% or whenever a turnaround occurs. And because we don't know when to actually time the market, even though a plethora of average investors or even professional talent believes that they can time the market, they can't. I'm sure you could time the market a few times, but no one can consistently time the market every time. So it's much better just to dollar cost in to indexes or high performing mutual funds or ETFs that track an index such as VOO, so you can build wealth over the long term. And this is something that I personally practice. I align my investing style to what I preach on here, and that's how I build my wealth. Not too many investors are actually likely to go shopping in an environment like we are seeing right now while all the stocks and the stock prices are falling. However, right now, this is my favorite time to buy stocks. I actually buy more aggressively during stock downtrends than I do when the stock market overall is appreciating, and Warren Buffett 100% backs my psychology and how the money works in the stock market. So despite a sweeping panic among investors of a stock market crash in 2022 or 2023, threats of a very bad recession, rising interest rates, this does not change the way I invest overall. I've also heard a great analogy that I believe Warren Buffett said, and he says that if you walked into your favorite store one day and everything was regularly priced, you would still buy your favorite items from that store. However, if you came back to that store a month later and all of your favorite items in that store are now trading at a substantial discount, you would buy more of the items that you like, and the stock market is literally the exact same. That's why I actually tend to buy more shares during stock market downtrends of my core investments than I do when it's uptrending, so I make money either way. I normally just make money later down the road when the stock market recovers, and if you look at the chart of the overall stock market, it has recovered 100% of the time over a span of 20 years or more. So if you want to follow that logic, then please, I would recommend to stay safe, invest into your core investments, which should be mutual funds, index funds, or ETFs, or very, very well-known blue chip stocks that are globally recognized as companies of value, which would also include, in my opinion, Amazon, which is one of the stocks that I am investing in despite the stock market downtrend. Amazon is an absolute titan when it comes to e-commerce and cloud computing, which is why I absolutely love this company. They are extremely diversified in their offerings, and they have a multitude of various subsidiaries under the Amazon umbrella. Now, with that being said, Amazon is not immune to stock market carnage or anything that's going on in the economy right now. If anything, if you want to be really safe, you should probably end up looking into companies or ETFs that track healthcare or consumer discretionary or finance. Those are the types of companies that tend to do very well during stock market downtrends. Or if you're a dividend investor, you definitely want to double down on your dividend stocks and have drip investing enabled so those dividends are reinvested back into the companies that gave them to you, so your next dividend is even greater and it's just constantly reinvesting and it just compounds that way, which is absolutely a great strategy that I also have enabled in my portfolio. So what opportunity are we looking at right here for Amazon's AMZN stock? Well, right now, Amazon stock trades for $117.14 per share, which is their current share price value. But analysts and professionals believe this company is worth anywhere between $110 and $232. Now, it wouldn't surprise me if the current stock price actually dropped below the $110 range over the next few months, but it definitely looks like the high side is still intact because this company is very fundamentally solid. So let's go over the bullish positive case for how Amazon is not only going to make money during times of stock market uncertainty, but why it's one of my favorite investments. So despite the recent economic slowdown and the decrease we've seen in global e-commerce sales, we're still projecting a total e-commerce market size of over $8 trillion by 2026, which is absolutely insane. And to put that into perspective, currently, at least for 2021, that market was worth around $5.2 trillion, so it's scaling extremely rapidly according to Statista. This means that Amazon is going to start scaling their sales growth, and it's also going to reduce its overall costs, especially as it invests into more of its automation investments to help drive profits. So Amazon is definitely going to have a large role to play in the global e-commerce market, especially because it's scaling so quickly, and due to Amazon having a giant portion of that market, it's going to pay off for them very nicely. Another very powerful argument that I've found for Amazon is their specialty when it comes to cloud computing, specifically revolving around their AWS technology, which is their Amazon Web Services. And they are a leading provider of cloud infrastructure services that outperform both Microsoft and Google in this particular space. Now, I also want to say that their cloud computing segment is extremely profitable. Literally, the industry is set to grow to $947 billion by 2026, up from only $445 billion, which is what it was worth in 2021. AWS is already highly profitable, and it brings in loads of money for Amazon because it's generated $5.7 billion worth of operating income just in the second quarter alone. However, despite this very good news, there are risks involved with Amazon. For instance, we have competition coming from both Walmart and Target, who are bolstering and investing heavily into their e-commerce capabilities, especially in recent years. One thing I'll highlight is that Target recently underwent an acquisition back in 2017, and they bought a same-day delivery platforming company named Shipt, which clearly puts them in direct competition with Amazon. Likewise, Walmart is also innovating on their e-commerce capability and their overall digital presence, so clearly that's going to be some competition in regards to their e-commerce platform when we're talking about Amazon. On the other hand, we see the cloud computing space is extremely competitive, where Microsoft and Alphabet, which owns Google, are extremely formidable foes for Amazon. Microsoft has the Azure Cloud Platform, which grew its revenue by around 40% during the most recent quarter, which is astonishing. Likewise, we've also seen this growth in the Google Cloud, which again, Alphabet owns Google, to where their Google Cloud revenue grew by around 36% in the second quarter of the year. So this is one of the reasons where a rising tide will lift all boats, and because cloud computing is so innovative and so important in today's economy, Microsoft, Alphabet, and Amazon all have a fantastic future. Yet it's very important that the e-commerce segment of Amazon, as well as their cloud computing segment, have massive markets, so clearly there's enough market share to go around for Amazon and other companies. But I just think that Amazon is clearly a market leader in these two various spaces. Amazon's stock is currently trading for around 33 times their operating cash flow from operations, and that's near its midpoint of what it has historically traded at. However, for such a high-quality business that is projected to grow at a 33% CAGR, or an annualized rate over the next half of a decade, this is absolutely very promising to identify a rapidly expanding blue chip company that has this much growth potential. So despite this, there are risks when you are investing into a company like Amazon, but overall, Amazon is one of my larger holdings in my portfolio, and I think it's a very attractive long-term buying opportunity, and this is one of the companies that I'm going to be buying even if the stock market continues to trend downward or if the economy goes into a full-on very negative recession. I still think that companies like Amazon and other blue chip companies are a solid buying opportunity right now, especially if we want to incorporate the two things that Warren Buffett said to us: to be fearful when others are greedy and to be greedy when others are fearful. So to buy while the stock market is falling, and then like with his other analogy where we go into our favorite store, we buy the same items but now they're cheaper. The same thing works with stocks. We want to buy stocks that we already like, but now they're even cheaper. So why wouldn't we go and capitalize on that opportunity that the market has given us? So I would love to hear your thoughts down below. Remember to stay safe out there, subscribe if you are new, and I will see you in the next YT video.